Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There is a lot happening in markets. We are about a month out from Trump's Liberation Day tariff announcements. The Australian election is coming. Canada's election happened. There's plenty happening. We're going to cover it all. But that's not all we're going to cover in a big episode of Equity Mates. You are bringing a stock to the table today.
Yeah.
One that I don't think a lot of people will have heard. And we're going to close out with a number of community questions because we've been getting heaps. And we're going to try and answer as many as we can.
Yes.
But before we do all that, we just want to remind you that if you enjoy what we do here at Equity Mates, we have 2 emails that you might enjoy. We have a daily news email, 6 a.m. every weekday morning. We share the news that you need to know in a short dot point format. And then if you are a financial advisor listening or watching, we have our Basis Points email that accompanies our Basis Points show. So plenty to keep you listening and learning and maybe sometimes occasionally laughing. We're not that funny, but we're funny for finance. So
Yes.
You can subscribe to either of those emails in the show notes.
News and markets.
Let's start with the news, Ren. Today we're going to cover off, as you said, it's 1 month today since Liberation Day. So we're going to have a look at where we're at.
Yep.
And earnings season in the US is well underway. And one of our favorite companies has had some pretty amazing results.
Now, before that, Bryce, I'm going to ask you a question without notice. What's the price of eggs?
I know this, $8.80.
Oh, you've nailed it.
Put me up for PM.
Yeah, well, I had the clip ready to play of our Prime Minister candidate.
Dutton was pretty off.
Yeah,
$4.
$4.50, he
$4.20
said?
or something.
Yeah.
I hate the question. to
I
be
know.
honest. It's
Hate
ridiculous.
I hate the
ridiculous.
gotcha questions.
Yeah.
There was that famous moment in the last election, 2022 election, where Adam Bant just responded to a journalist, "Google it, mate."
Yeah.
When he was asked something, which
Not the response either. But
I liked. Yeah. Anyway, Australian election is coming up, 3rd of May. Already more than 2 million people have voted, so the election is underway. We released our election series last Friday. Wherever you're watching or listening to this, you can hear our conversations with the 2 men vying to be treasurers and the 2 leaders vying to be Australia's housing minister.
Yeah. So Liberation Day, we are 1 month on. A reminder that was the 2nd of April where we all woke up and Trump had, or it was the day that Trump announced the sweeping tariffs across...
Reciprocal tariffs?
Reciprocal tariffs with weird formulas across the world.
Well,
And
let me ask you, Bryce, do you feel more free?
I feel no different.
Do you feel liberated?
I feel no different.
I guess it's because we're not American. Thank God they must feel free over there.
They're loving it
They're
over
land
there.
of the free, but now they're liberated.
And markets got crunched. The ASX was down 8%, S&P down 12%.
Yeah.
The Hang Seng was down 15%. There was a sea of red.
Yeah, there was a bad week.
Yeah.
But, we're almost 1 month out. We should timestamp this. This episode gets released on the 1st of May, but we're recording on the 29th of April. But the numbers aren't that bad.
No.
And so if we just go around the grounds and have a look, the ASX 200, Australia's stock market, is actually up since Trump announced. Since the 2nd of April, we're up 0.8%. But actually, because Trump announced overnight, we actually really should be looking from the 3rd of April.
Yeah.
We're up 1.7%.
Hell yeah.
God, hope people didn't
Sell out, I
or
know.
feel that initial 8% crash in those first 3 or 4 days and then sell and miss the rebound.
Yeah.
I think we did some content on that.
We did a lot of content on that.
But look, Australia is the only major market that we're looking at today that is actually up. But I think the story 1 month out is it's not nearly as bad as you would have thought based on media headlines or based on some of the panic in that initial week. The US, the S&P 500, down 2.5%. As you said, it was down 12%. The Hang Seng, the Hong Kong index, but a lot of the big Chinese companies list there, down 5%, was down 15%. The mainland China index, CSI 300, down 3%. FTSE 100, the UK index, down 2%. Stock 600, which tracks mainland Europe, down 2.5%.
Not all that bad.
I mean, if you told me
Not all that bad.
if you told me a month ago those numbers happened, and you didn't
Yeah.
tell me what happened within that month,
Yeah.
it would have just felt pretty normal.
Absolutely. I mean, it also goes to show, so we've said it time and time again, but if you tried to sell out to pick the recovery, a high chance you've missed it. And the reality is it's happened in a reasonably short period of time. So don't sell.
Where it goes from here, nobody knows. That's the important thing. And anybody who tells you it's going to go in a certain direction, they're just guessing. They don't know. And the more conviction they have in that view, the more you shouldn't listen to them. Nobody knows. But the fact that nobody knows is the reason we keep saying you've got to just stay the course, stay invested, and think long term.
I'm feeling pretty good about it.
Oh, I'm feeling great, but I felt great all the way down as well, because it's like
Bye.
the more you know about stock market history, the more you realize that these falls are buying opportunities.
I know. I look back on that. I'm glad I did what I did.
Yeah.
Yeah, because every time we've had that opportunity before, I've waited too long.
Yeah.
Yeah. So
We actually made some content about that as well.
yeah.
If that's not a sign that you should subscribe wherever you're watching or listening, I don't know what is. But look, that's the past month. But the thing about the markets, the thing about business, it is constantly moving forward. And we go from one thing to the next because we are in earnings season and we are getting a whole bunch of new information.
Yeah.
We spoke about Tesla's profit falling 71% in a previous episode. But another big tech company caught our eye. So we want to talk about Alphabet. But before then, I want to just share a quick note that JP Morgan released.
Yeah.
So their trading desk has turned tactically bullish on US equities. They predict that big tech earnings and trade deal announcements could lift stocks, but have warned that the rally's momentum could fade within weeks. So I think it's a sign that there's a glimmer of hope, there's a bit of positivity here, but they're signaling that things could still change, week on week. But one of the big reasons for that glimmer of hope is what Alphabet announced.
Yes. Alphabet, parent company of Google, a position in both Ren and my portfolios, has absolutely shot the lights out. Let's have a look at some of the numbers that absolutely smashed Wall Street expectations. $90 billion in revenue for the first 3 months of 2025. That's up 12% on the same time last year. Profit in the same period of $35 billion. That's up a whopping 46%. If you do the numbers on that, that's a 39% profit margin.
I know, it's crazy.
What?
It's actually crazy. Yeah. A lot of people, a lot of ink has been spilled calling the death of Google, the AI chatbots are going to eat into their search revenue. But this is a company that does $90 billion in revenue and makes a 39% margin on that revenue. It's like there's going to need to be a lot of chatbot searches to eat into that power.
Yeah.
And I think, the driver of Google is search.
Yes.
There's no doubt about that.
Yes.
Cloud computing is growing. I think it's of the 90 billion. This is off the top of my head, but I think it's like 12 billion revenue of that quarterly revenue came from cloud. So that's like growing, and it's becoming a meaningful chunk of the revenue. But the unrecognized powerhouse of Google, well, at least unheralded, is YouTube in my mind.
You reckon it's unheralded?
I think it's underrated. Sorry, it is heralded, but underrated.
Well, what does it meaningfully contribute?
Well,
I think that's always been the argument. I remember we had an interview with Mary Manning, and we put that to her. We said, YouTube, are you kidding me? This is, on its own, would be a giant of a business. And she was just saying that is a total proportion of the YouTube of Google's business. It's not going to seriously move the needle at that time.
So I've got some numbers. So this is the YouTube advertising revenue. This doesn't include YouTube subscription revenue.
Okay.
So this isn't a complete picture, but it does tell the story. Trailing 12 months, so last 12 months from this reporting season, $37 billion in ad revenue.
Okay.
Now, they did 90 billion in a quarter, call it about 10 billion in this quarter from YouTube ad revenue. So meaningful.
Yeah.
Obviously not the lion's share, but meaningful. But compound annual growth rate over the past 5 years, 18%. So YouTube ad revenue is growing faster than overall Google revenue. It's becoming a larger slice of the pie. But if you look back, 5 years ago, the the annualized YouTube ad revenue was about 18 billion. And now it's 37 billion. It's pretty impressive. But here's how I want to contextualize it. Let's compare it to Netflix, who is having a great run. They're up 25% year to date.
Yep.
They're just shy of a $500 billion market cap.
Yep.
What do you reckon Netflix's quarterly revenue is?
Like, I actually have no idea. I can't remember. 40 bill?
No, quarterly.
Oh, no idea.
10 bill.
10.
Yeah, it consistently, it's, does about 10 bill a quarter, 40 bill a year. YouTube's last 12 months advertising revenue, not including subscriptions, 37 bill.
Yeah.
So
Not
like,
bad.
if it just was, and like obviously there are differences between the Netflix and the YouTube business, but similar revenue numbers,
I'm just also looking. So
Yeah, I feel like the weight of the analogy is being lost on you here.
No, I like it. I'm also just looking at subscribers versus the other two. It's a bit hard though because you've got users that don't pay on YouTube that's helping to drive that revenue as well. Yeah, 2 billion users. Yeah, I feel like, look, here's a really bold call, really bold. Search as it is will not be, in 5 years, will not be as it is today. I think AI will really change it. And I reckon Google might want to spin out YouTube on its own.
Maybe.
Yeah. I think
but
if they can't figure out, like the way that they're doing search at the moment, I think the business will change. Like how they monetize search is a question mark for me.
Yeah, I don't think they're gonna say, oh well, our cash cow is dying, so we're gonna spin out one of our faster growing segments. That doesn't seem logical.
Why not?
I mean, shareholders might ask for it because they might feel like the full value.
That's what I mean. It's like, get rid of this.
Yeah. I mean, the SEC is trying to break up. No, sorry, the FTC is trying to break up Google. So look, we've spoken about Google before. It's such a big company. It's so well known. It becomes like, is this too obvious a play? But 39% profit margin. Last 3 years, revenue's grown at 11% a year. Last 3 years, earnings per share has grown at 13% a year. It's trading on 18 times earnings.
18 times.
Yeah, it's just like Well, Bryce, let me close this segment by asking you, if YouTube was a standalone company, if you got your wish, and you could choose between Netflix and YouTube as an investor, what would you choose?
YouTube for sure.
Why?
I think the way that people are used to a revenue model on there is better than Netflix. Like, you just expect ads if you're not paying for it. So I think that's not that obtrusive. There's a shitload more users.
Yeah.
And they don't have to create content themselves.
Yeah, that's a big structural advantage, isn't it?
Yeah.
That Netflix have
other
to
people. They
pay
have
for
us slaving away. Slaving away, creating content for them and slugging us 50%.
Yeah, so you'd expect their gross margins are a lot better because they don't have the cost of content the same way that Netflix does. But look, I think that's probably enough about Google. If you want to keep up to date with everything that's going on in earnings season, in markets, we have our daily news email that you can sign up to 6 a.m. every morning in your inbox. Link is in the show notes and YouTube description.
The market downturn is throwing up opportunities, and Ren, I have a stock today that is the most recent that I've added to my portfolio, and I bet, or you may not have, because you have heard of a lot, you read widely, you may not have heard of it.
Well, tell me what it is.
Good point. The company is TransMedics Group, TMDX.
The name, I don't know it.
Okay, nice.
Yeah.
Nice.
Like, the name vaguely rings a bell, but I would have no idea what it does.
Nice.
Something medical.
Yes, medical. It's the leader in organ transplantation.
Oh, stealing kidneys.
No, not going that far. Although I will get to a little bit of controversy later on in this.
Oh God, here we go.
But
so wait, the leader in organ transplants.
It's the leader in transporting organs.
Oh, not transplants, transports.
Transporting organs.
Someone has a car crash, they're in a coma, they're an organ donor. The hospital harvests their organs, I guess is the verb. and then they call TransMedics to transport them to the other hospital where the transplant takes place. Is that the vibe?
They've got the system to do it. Yes.
They've got an ambulance.
No,
Or a
well, let me get into
helicopter.
it. Let me get into it. So I'll start with the problem. Traditional organ transplantation faces a few challenges. There is a what they call short viability window. The way that it's traditionally done is organs are effectively put on ice.
Mm-hmm.
And so the length of time that those organs can stay viable is actually very short, 2 to 3 hours. What that then leads to is a large amount of organ wastage. Only 3 out of 10 thoracic organs, so that's hearts, lungs, are actually transplanted and used. So a serious amount of waste. There's major logistical challenges because of the short window. You can only move it so far. And because it's sitting on ice, doctors aren't actually able to evaluate or actually work on the organs to improve the condition while it's outside of the body. So that's the problem. Where TransMedics steps in is through the development of what they call their organ care system. Now, the medical term for this is, and I know there's probably going to be a lot of doctors listening, so forgive my pronunciations, but it's normothermic perfusion. In layman's terms, that means that this system can keep the organs warm. They supply it with oxygenated, nutrient-rich blood, which mimics the conditions inside the human body.
That's cool.
Yeah. So what that means is that they can preserve the organs for a lot longer, and in this case, up to 4 times longer than cold storage, so up to 20 hours. That then means that they can transport the organs further, and it also allows doctors in real time to monitor and assess the organs and actually work on them if they need improvement before going into the body. Obviously, the flow-on effect of that is more transplants can be done. The added kicker is that they have spent huge amounts of capex over the last few years on integrating their own logistics network. So not only do they have this system, organ care system, but they have a logistics network. They've gone out and bought their own fleet of planes and trained specialists to handle the entire process.
Epic.
So it's a pretty innovative system that is making meaningful impact to organ transplant. They currently have their kidney system fully up and running.
Okay.
They have their liver product has 30% penetration of the market. Their lung product's just to come to market, 5% penetration, and their heart product is in major trials at the moment.
Epic.
So I don't think it's a one size fits all. They're still obviously working out the system for each of the major organs.
So that sounds really cool.
Yeah, it is.
It does sound more costly than putting on ice, even though there's better outcomes, which leads to the eternal question when you're talking about American healthcare companies, which is
That's a good point.
who pays? Because obviously it's a complicated network of government, insurers, hospitals, patients, none of whom can really afford the costs that come down the pike in the American
Reminds me
healthcare
of
system.
the pit.
Yeah, it does. Yeah.
Yeah.
So
Where they're getting hounded.
in this case, who does pay?
So, Ren, the primary payers are the transplant centres and the hospitals themselves. They're paying, or they're the direct customers paying for the system and the logistics services. I guess indirectly is then the healthcare providers.
Or the
the insurers.
Yeah.
The insurers.
For the patients.
For the patients,
Yeah.
yeah. So I think if you think about the fact that this system should be able to increase transplants from the 3 out of 10 to call it 5 or 6 out of 10, the flow-on effect that then has for them going and I guess generating more revenue from doing more transplants. So that's where we're at. Back on track. So let's have a look at the financials, Ren. Revenue CAGR is 65% a year over the last 5 years.
Wow.
They have recently pushed into profitability in the last year. The reason that they've been unprofitable for the previous years is, as I said, huge capex expenditure on aircraft and their logistics fleet.
I mean, CapEx doesn't hit your profit line. Well, I mean, it does over time with depreciation, but
they've been spending a lot. They are expensive, trading on a PE of 95. So
But I mean, if they've just hit a profitability inflection, it's
yes, yeah. So and it did 441 million in revenue in 2024. That's an 83% increase compared to 2023.
Wow.
Yeah. They have given guidance as well that they want to hit 1.2 billion in revenue, I think, in the next few years. So
Well, I mean, we all want to hit that.
Sure. Well, they reiterated the guidance that's what they're on track
And so
by 2026.
So I just had a look. It's a $3 billion market cap at the moment.
Yeah.
Yeah.
So I think they reckon they're going to double revenue in the next 12 months again.
Okay.
Anyway, so they're expanding into the US market. Currently, they have 20% of the US transplant market, up from 6% in 2022. The interesting thing is that they're actually driving the growth of the transplant market because of their ability to actually extend
cool.
transplant life. So to put some numbers to this, total transplants delivered not through TransMedics over the last 2 years is effectively flat.
TransMedics. Now you're getting the name of your company wrong.
TransMedics has effectively been flat at about 14,000 a year.
Okay.
So the growth in transplants in the US has been purely driven by TransMedics. TransMedics. I don't know why I'm saying TransMedics. TransMedics. Adding an additional 3,700 in 2024, they hope to get to 10,000 transplants by the end of 2026.
Cool.
So taking market share. Now let's look at performance. Up 40% year to date.
Yep.
If you look at the share price, though, you will find that in 2024, late 2024, there was a pretty significant price decline. And that was because there was a scathing report that came from short seller Scorpion Capital.
Oh, damn those scorpions.
So this is a bit of a Mr. Beat Up stock. They released a 340-page report outlining a number of things from kickbacks and billing fraud, organ trafficking and unethical...
my kidney call. Right.
Unethical practices, off-label use, and a US congressman also came out and publicly accused them of overcharging and misappropriating resources.
Sorry, you might not have the answer here, but what is off-label use for organs?
Don't know. Yeah, that's just something I pulled from their report. Yeah.
Right. Okay. So that was the 340-page report in 2024,
and the price and the stock price got pumped.
But more importantly, like, were the allegations, because like some of those things are criminal. Organ trafficking is criminal.
Absolutely. So with all short reports, people dug into it. A lot of critics have noted that much of the evidence is anecdotal and from unnamed sources, and that the truth to the claims highly questionable and largely unsubstantiated. Of course, the company's come out and tried to refute the claims pretty strongly and have done so, I guess, quite successfully. But they are still under investigation by a few law firms and may face further regulation or regulatory action. But I think, as we can see from the stock price, a lot of investor confidence has come back in. But I think that's kind of why it's come across or become of interest, is because it's down from its highs. And if you believe in the fundamentals, then it's a pretty interesting time to get back into this company.
Yeah. So I'm just having a look at its share price. So from August, when the short report was released, until the end of January, it was down 68%. So it lost more than 2/3 of its value. But then since then, it's up more than 50%.
Yeah. So look, the company has come out. They've reiterated their guidance. They've refuted the claims from this Scorpion Capital. A lot of investor confidence, I think, is coming back into the company post this report. I mean, it's pretty hard to deny, if a lot of the accusations are untrue, the fundamentals of the company are pretty appealing, pretty strong growth, increasing market share and market penetration, and what seems to be a genuinely innovative solution to a problem. And that's not even with, huge runs on the board for heart transplants. Lung, as I said, is only at 5% market penetration. So a lot of good things to come or to think about when it comes to this company.
That is a fascinating company. It's just a reminder of why investing is so great. Like, just what you learn about, like, interesting people, innovative companies working on hard problems, and the opportunity as investors to back those people doing that work from your couch.
Yes. Yeah.
But like that, to be able to invest in, these innovative companies where the world is going. Obviously, I haven't read this short report, so
340 pages.
Yeah. But fascinating company, TransMedics.
TransMedics, yeah.
Or what were you calling it? TerraMedics.
TransMedics, TMDX. Welcome to our newest segment, the Unhelpful Desk, where we give general advice to specific questions.
Yes, we get a lot of questions here at Equity Mates that do border into the universe of personal financial advice, asking about like very specific things and what people should do. We obviously can't give personal financial advice here at Equity Mates. We also just don't know enough about you and your goals and your circumstances. But we want to answer your questions. We don't want to leave people hanging.
No.
And so we have come up with this concept of the Unhelpful Desk, the world's worst help desk. We're not going to solve your problems, but we might give you something useful to think about. So, Bryce, we've got 4 or 5 questions here?
Yep.
Some of them are voice recordings. Some of them we'll just read out. If you do want to ask us a question, there's a link in the YouTube description or the show notes. Would love it if you did a voice message over a written message. But Bryce, who's our first caller for the Unhelpful Desk?
Yes, the first person that's probably going to be disappointed is William.
Hey boys, it's William here. I'm currently a very broke uni student, and my question today is around how should I balance saving for a house deposit and investing? Like what sort of percent you should balance between the both?
Well, William, we appreciate the question and we highly commend you for thinking about investing while you're at uni. I think it's an epic time to start. Unfortunately, we can't give you an answer on what percentage you should allocate to stocks, what percentage you should think about saving for a house deposit. But Bryce, generally, how would you help William think about this?
I think it's all about time frame for William to consider. If he is looking to buy a house in the short term, I would be prioritizing savings and prioritizing keeping it safe. If you have a much longer term, and I'm talking 7, 10, 15 years, then you could start thinking about splitting your investments or perhaps even putting your deposit into the stock market. But I'm talking a very long-term time frame, because at the end of the day, you don't want to be losing the money that you're saving towards that house by putting it into the stock market in the short term.
Yeah, and my final thought, William, would be just be realistic about your chances of buying a house in the short term as a very broke uni student.
Yes.
We've all been there. We all know what the state of Australia's housing market is. And so be realistic about your timeframes and remember that with the stock market, you can start growing your wealth with very small amounts of money.
Stay out of consumer debt.
Yeah, that's a good one.
That's the biggest thing.
Yeah.
Stay out of consumer debt and recognize that it's okay to be broke as a uni student.
Yeah, and have fun.
Have fun, exactly. Exactly.
All right, well, that was our first caller through to the Unhelpful Desk. The next one comes in via Instagram from Jack. I'll just read it out and then, Bryce, you can share your thoughts. So Jack first started with a Raise account, raising up $10 or $15 a week, but recently opened another brokerage account and has started putting more of his dollars in that account. He's got about 40% of his total invested in Raise and then about 60% in his other brokerage account. He's wondering at what point should he consolidate them into one account? Should he keep one or get rid of the other? Which one should he keep?
Very common scenario, I think. We see a lot of people starting with a Raise-like app, feeling confident with investing and then looking to grow and take more control. So I think to start, Ren, you don't need to consolidate is the first thing, but there are a few things that Jack could consider. So firstly, reasons to consolidate, obviously simplicity, fewer accounts, easy to manage, simpler tax returns. Lower fees if you're consolidating into a cheaper option and you're not paying fees on the Raise account. The third is you just have more control. Raise, there's predefined funds, whereas obviously going to a broker, you can build the portfolio how you want. And then that leads into more investment options as well. Stocks, you effectively have the entire market at your disposal.
And also overseas
markets. Yeah. So those are some reasons, Jack, to consider consolidation. Ren, anything on the reasons to not or keep both?
Yeah, probably the biggest one would be the tax implications. If you sold down Raise, there would be a capital gains event, and that would be something to consider. The capital gains tax you pay may be far higher than the additional fees that you're paying with Raise. Functionality, you might like the roundup functionality of Raise. I don't think any brokers offer a roundup functionality, not that I can think of. And then finally, it's just like I was about to say a laziness thing, but that's like a pejorative way of saying it. It's just like there may be no benefit to doing it.
Yeah.
Like you can have 2 accounts ticking away. I mean, the main thing to think about would be the fees and then the investment returns you're getting.
Yeah.
But yeah, Jack, as we said, this is the Unhelpful Desk. So we'll give you something vague, like think about the fees and the returns you're getting.
Nice. All right. Well, the next one's come in from Andrew.
Hi guys, I've got a question about what's the minimum dollar amount you believe you would need to invest each week, month, time period. I hear, Bryce, you do a 30% savings, and Ren, you're trying to get up around the 25% savings. But for someone that's on a pension, 25% of not much, it's still not much. So is there a minimum dollar amount you think per month that you would need to be an investor?
Love that question, Andrew. And like short answer, no. There's no minimum amount that makes investing worth it. The great thing about investing is you can start with small amounts. You can increase that over time. But whatever you invest over the long term is you're really just preserving your purchasing power today so you can purchase more in the future.
Yeah.
And what is then enough to invest is really dependent on the goals that you have and the time horizon you have to get there. But it's a piece of string question, unfortunately. Bryce, you've done some scenario testing here.
Yeah, well, just to show that, like, even with small dollars, it makes a big difference. If you were to invest $10 a week for 20 years at the average 13%, which includes dividends reinvested that the ASX has done over the last 100 years, you would have contributed $10,400, but you would have a portfolio of about $48,000 over that 20-year period. If you just doubled that investment to $20 a year for 20 years...
$20 a week?
Sorry, $20 a week for 20 years, you'd be investing $20,800, but you'd have a portfolio of almost $100,000.
Well, let me even go a more extreme example. This blows the timeline out a bit, but $10 a week for 40 years, 13% return, you have over $500,000.
There you go. So that's pretty impressive. So I think the main thing here, as Ren said, there's no amount too small. The main thing is actually getting in there, doing it, and investing whatever you can.
Yeah. And thinking about what you're investing for and your time horizon and when you want to receive that money. Again, it's all we can do in the Unhelpful Desk.
Yes.
So we got one more question to close it out for our first edition of the Unhelpful Desk. This one comes in from Bryce.
Blake.
This one comes in from Blake.
G'day, equity mates. Blake here. My wife and I are in the fun chapter of having 2 girls now, and we want to put away $100 each for them every month so that when they are 18, they can have a little nest egg that we would teach them about money and award them that they can do what they need to with. But my question is, should we be putting that $100 a month into a high interest savings account to build that way, or should we dollar cost average and invest that money? And so over time, hopefully it's also grown a little bit as well, maybe more than what the $100 per month would have been. Thank you very much. Love your work, boys. Bye.
Love that question, Blake. Thank you for a reminder here at the Unhelpful Desk. We can only give you general advice to your very specific question. But Bryce, how would you think about the choice between a high interest savings account or investing in the stock market? And I mean, implicit here is Blake is investing for his kids, so the time horizon is long.
Yes, and I think that's what plays into Blake's hands here a lot. And for me, it's just doing the maths on this. Let's put the scenarios head to head. A high interest savings account today is spitting out roughly 5.5% per annum. We know that the long-term historical average for the ASX here in Australia or the All Ordinaries has been 13%, which includes dividends reinvested. If we were to contribute $100 a month, as Blake wants to do, for 18 years, he would have $21,700 invested. If that was in the high interest savings account at 5.5%, his kids would have $35,639. Pretty good. Great way to teach them. Nice little lump sum to have when you're turning 18. If you, though, Blake, you were to invest that in the ASX 200 and get that 13% return, you still would have contributed $21,700, but your kids would have just shy of $75,000 sitting in that investment account. So more than double what they would have if you were investing in a high interest savings account. I think remember as well that over the long term, over in the US, and the figures sort of carry through here to Australia as well, there's no 20-year period where you would have lost money if you'd started investing. So I think the long-term risk here, time is on your side. 18 years is a long time, and the market can really do wonders over that period.
I actually think that the difference would be greater than, because I think that 35,000 that you've got for the high interest savings account doesn't factor in the tax you pay each year.
It doesn't,
on the income.
It doesn't.
Yeah. So obviously both have tax implications. High interest savings account, you get interest every year. You pay tax as you get paid that interest. The ASX 200, there may be some dividends, but really the majority of that growth that you're talking about there is from the capital growth that you pay capital gains at the end of the 18 years.
Yeah.
There may be some ways that financial advisors, you can just give it as a gift to your kids, and that's not a taxable event, perhaps. I don't know. Again,
unhelpful advice.
General advice to your specific problems.
But I know what I would be doing, that's for sure.
But we're not going to say anything more because that is our job here at the Unhelpful Desk. But Blake, hopefully we've given you some broad sketches of.
I would also say getting them excited about the stock market versus a high interest saving account would have long-term implications as well.
I mean, you're the classic example of that. Your parents got you interested in the stock market when you were a kid, splitting your pocket money into 3 buckets, and look at you now.
Struggling away.
manning the
unhelpful help desk.
Giving general advice.
Anyway.
But yeah, I agree. I think getting people excited about finance is the best way to keep people engaged and improve financial literacy.
Absolutely. Well, thank you to William, Jack, Andrew, and Blake for your questions. We really appreciate it. The inaugural questions for the Unhelpful Desk. If you have some questions that you would like general advice to, your specific questions, head to equitymates.com/contact. Please leave us a voice message. We love hearing from you. If you don't want to do that, you can write to us as well. But Ren, that brings us to the end of a massive episode. Really looking forward to picking it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.